The Vunani Growth Fund is a higher risk fund that aims to deliver real returns over the medium to longer term, and it was launched in January of this year. The fund has returned 11.2% year to date. For more, the portfolio manager, Lowton, joins us in studio. I'm going to ask with how you define growth, just to kick off this discussion.
I'd say growth companies are those which deliver superior returns year on year, with companies that have the ability through, strategically and operationally to grow revenue, grow earnings year in, year out.
So this now is growth versus value. Do you think that the lines are becoming somewhat blurred, Viv?
Yes, many people now are looking at the Warren Buffett model of looking at just at value, buy something when it's cheap, and often some things are cheap for a reason. Just look at any telecom investor and he'll tell you the same. But with regards to growth, what particular aspects do you look to identify a growth company versus what you would think may be a value company?
Well, in terms of our stock selection process, firstly we look at our sector allocation, which we take a guide from our group economist. Sector allocation obviously.
So this is from a macroeconomic perspective?
Well, yeah, just to begin with, as a base for our sector selection. Sector selection, very important, can determine up to 70 to 80% of returns. All
right, I need to push you a little harder on this in terms of sector selection. So if your economist says interest rates are going to stay lower for longer and we're going to see financial stocks doing incredibly well because consumers are going to start borrowing more, hypothetically speaking, then you would skew your portfolio to the financial sector.
Yes, most definitely. Firstly, in terms of, we all know the JSE is dominated to some extent by resource counters, but that's not necessarily representative of the actual South African broader economy. So we don't actually have a problem going significantly off market weight, if I can put it like that.
And Grant, I noticed we talked about the financial sector. You've been overweight in that for the last period of time. You've done rather well, and you've been underweight resources. What would trigger you to switch? Are you looking at a particular change at the moment? Or are you happy to stick with overweight financials, underweight resources right now?
Happy to stick with it at the moment. I think we are underweight resources, as you've correctly pointed out, but at the same time we are sitting with certain counters in the resources sector at the moment, some of which have obviously done better than others, but we've got quality companies in there, and we hope that if the turn in resources does come, if and when, we can benefit from that.
But you're not trying to time the change in the cycle with the resources, with maintaining this underweight position.
No, we don't find it necessary to try to time the market to that extent. We, as I said now, sector allocation very important, but we are stock pickers to a large degree, and that's what we try to do. We try to get into companies that are quality companies, have proven track records, and we believe will outperform going forward. So we don't feel it's necessary to get the timing absolutely right necessarily in terms of sector selection. It is important, but
I don't mean to harp on the sector selection, but then I'm assuming that your economists are saying right now that they are undecided as to the global recovery. That's why you aren't overweight the resource sector.
Well, very much so. I think we've been overweight financials and industrials, the entire year so far at least. That is changing slightly. The guys are saying that perhaps there's some sort of recovery coming. We've seen some of the resource stocks run quite a bit recently, very recently. So slightly less underweight in resources as we stand, but continuously monitoring that, and we'll see how that goes going forward.
And particularly once you've got your sector selection done, obviously you don't pick every stock in a particular section. When it comes to particular stock choices in a selection, for instance, you talk about the telecommunications sector, I think, or MTN as opposed to Vodacom. What would drive that particular decision?
Well, in terms of our stock selection, all your bread and butter metrics that you look at, PE ratios, earnings forecasts, etc. But more importantly, there are some principles that we adhere to quite strictly. For example, we look at companies that force continued upward revision in analyst sort of prospects.
And you're saying that would be an MTN over a Vodacom, that it's got a stronger growth proposition?
Yeah, the reason that decision was made was that we see MTN as being a successful South African and African growth story. It's just the growth prospects, the pedigree of the company. It's got the track record of doing deals that have been successful in the past. and we see no reason not to continue to go with that.
Speaking of something else that you have a high holding in is Astral Foods. That's been quite hurt recently by the kind of turmoil we're seeing in the, the soft commodity sector, the corn sector, especially with the drought in Australia and the US, etc.
I see you picked out the one that's not done that well.
No.
Thanks, Viv. But,
But in terms of you look at that particular thing, what are your views? I mean, would you choose to maintain it, or are you looking at maybe getting rid of it or holding?
Well, look, Astral Foods got down to around about the region of $100. I think the lowest close was somewhere in the region of 101. We've set a mental stop at $100. We feel that if it breaks down through there, there might be significant downside, and that's when we'll decide to get out. But I mean, it's about sort of 5-6% from its lows at the moment. We don't believe that extreme conditions like drought, persist continually. So hopefully that might change. Maize price, just abates a little bit. Gives them
if the situation changes for Astral, where could we go to in terms of the upside? You say you've got to stop at 100.
It started the year at about 120. So I mean, I think that is at least where it could get back to quite quickly. And certainly that's what we're hoping. But I mean, we're agile. That scenario doesn't necessarily have to play itself out. If the drought persists, if the input costs and the maize price stays high, we have no problem switching out of that into something with better potential.
When you say you're agile, how often do you change your stock selection?
Well, this month, for example, on the growth portfolio, we've only made one change. The previous month, no changes.
What change? Can I drill down into what change?
Yeah,
you
we
made?
got out of Sappi and we got into Imperial. Sappi just, since the lows in about 2000 and the financial crisis lows in 2008 or so, it's just sort of trended sideways to slightly downwards. The reason we got into it at the beginning of the year is because we thought analysts are positive on it. The ratios look good. But, once again, if the market doesn't like something, it doesn't like it. And
there may be a better opportunity elsewhere.
Yes. Speaking again, going back to the kind of the signals we talked about here, with regards to the financials, I mean, are you basically agnostic across, the banks versus the life insurance sector? Or is there a particular sector in the financials that you're thinking right now offers more value?
Well, I mean, I'm actually updating all my models in that at the moment, but I know a little while ago the insurance companies looked, particularly good value at some point. But I mean, we've got a spread across the board: insurance, banking, as you know.
In the banks, which of the banks is looking most attractive? Would you now look at it and say, well, ABSA has fallen relatively hard, so that could be the potential kicker? Or do you look at something like a Standard Bank, which potentially mirrors your MTN strategy? It's got first move advantage on the African continent and perhaps can deliver extraordinary growth on that front.
In terms of something like an ABSA, we hate to try to bottom pick. I mean, obviously it's probably reached its lows already, but the point is sometimes, if not always, someone out there or the market probably knows more than you do. And I'm not advocating, complete market efficiency.
Sounds as though you are. This is the efficient market hypothesis coming to fruition.
Yeah. But, there's a reason why it's been beaten down like that. And just because it's come down does not mean that it will necessarily come up with the same quantum or speed. So I'd personally rather stay away from something like ABSA, stick with something like a First Rand or a Nedbank that is just, more consistently.
You didn't like my Standard Bank throwing in that there were some similarities with MTN.
We've got various portfolios, and Standard Bank is in one of them, and we like that story. African growth. I mean, Africa, the new sort of growth region of the world type of thing. So Standard Bank, no, it's a good one.
And with regards to, you spoke about African growth recently, and obviously the main play internationally that you've seen through African growth has been the retailers. What is your view on retailers? Do you think that some of the movement we're seeing is justified, or do you think they may be a bit overvalued right now?
Retailers. I think in terms of some of those counters, they've been called expensive for quite a while now. One of the shortfalls, or one of the areas where analysts often get it wrong, and not necessarily to any fault, fault of their own, but analysts obviously have a tough time in terms of predicting how these companies, firstly on the earnings side, can grow earnings, do deals, etc., going forward. It's tough to predict that sort of thing. Out of retailing, a company like Aspen, for example, always looks expensive, but if a company and the management has the ability to continuously doing value accretive deals, then a stock can keep going up, In terms of the other side of the coin, in terms of the rating on some of these retail companies, as we know, a lot of foreign buying. A lot of these foreigners, due to, for one reason, the lower interest rates that they have overseas, they tend to pay higher multiples for these companies. And if you're going to get a case which you've had, where you have foreigners coming in and buying a lot of the local retail companies, you're going to see them re-rate up. And that combined with earnings growth means, you've got the sort of performance that you've been having.